Viewers, due to the COVID problem, I got stuck in a place called Mangalore, my hometown, in a lockdown. So I have to record this video with whatever the facilities that we have. I'm not sure what could be the quality of this video, but nevertheless, I don't want miss talking to you at a periodical interval. Today's topic that I have picked for you is how should your financial plan be? The first thing that you have to keep it in mind when you drop a financial plan is it should be as simple as possible. That's absolutely essential for success in financial planning. This is NRI Money Clinic for you, and I am Dr. Chandrakant, but investment consultant and a financial planner.
NRI Money Clinic. No hype, just the right advice.
What makes your financial plan a very successful one? Let's look at all the things that you need to do or all the things must do one by one. The first thing that you have to ensure is your financial plan should look very simple, the simplest possible model you should adopt. Many people have this habit of venturing into too many things, diversifying into a lot of things. At the end of the day, what happens is their financial planning exercise is not succeeding as the way it should succeed. The financial planners or the investors themselves, if they are a do-it-yourself investor, do not know what all the things they are carrying, how it is working, for what purpose they have put in, and they get lost. So when you try to put too many things into your financial plan, or if you try to spread it thin and wide, then your financial plan will not work as you wanted it to work. So the first thing you have to keep it in mind is keep it as simple as possible, and that is very essential to create a successful financial plan. Point number two, it is just not essential for you to invest in each and everything that is available for you. There are commodities, there are stocks, there are mutual funds, there are cryptocurrencies. You invest in dollar assets, there are structured notes, there are ETFs, there are indexes, different shades of mutual fund. Is there a need for you to invest in each and everything? The answer is very clearly no. You should choose those instruments which fits your risk profile, which you can understand, which makes it very easy for you to monitor. Each asset class, each product behaves in a different way. These products have been designed keeping a particular section of the society or a particular constituency in mind. Some of the things that are available could be useful only in some territories. Some of the things that are available may not suit a particular nationality of people. Some of the things that are available may not be available for NRIs. Some of the things could be there only for the resident individuals. There is no need for you to venture into each and everything. Some people say, oh, cryptocurrencies are doing very well, let me go and buy. You don't need to do that. If you think your bank FDs can do a great job for you, and if you're comfortable putting your money in a bank FD, I don't see a reason why you would be venturing into too many things. If a particular stock is doing well, suddenly people will close some of their positions and go and chase these stocks. That's absolutely not essential. Instead of that, as per your original plan, whatever you have decided to invest your money in, whether it's an FD, whether it is gold, mutual fund, stocks, stick to your original plan. Don't try to go all over the place, and that can create a very bad failure in your financial plans. Number three, you should not be taking undue risk. There is no need for you to take that unwanted risk. When we talk about taking risk, two things come to my mind. One is your risk profile. If you're a person who cannot take risk because of your risk profile, you could be the person who is earning a low amount of salary, or your business income could be very low, or your saving abilities are very low, or you could be closer to your retirement, or you could be closer to your life goals. At that point of time, the event that you had planned, the life goal, is very close to getting fructified. At that point of time, all that you have to make sure is that the money that you have, it should remain very safe. So if you are in a position where there is no need for you to take so much of a risk, Because the life goals are near, you shouldn't be taking that undue risk. Likewise, there are a lot of people who are in a very, very comfortable position. They have so much of a money, whatever that they want to do, they can achieve using plans which does not need to take a big amount of risk. So if there is no need for you to take the risk, even though you have a risk taking ability, there is absolutely no need for you to take undue risk. When you take that undue risk, remember, not every time you will get away with it without the risk playing its role. So if there is no need for you to take risk because of your financial positions, you are comfortably positioned to achieve what you wanted to achieve, then avoid taking that risk. When you write your financial plan or when you get into a financial planning exercise with the help of a financial planner, all the time think what can go wrong. This is absolutely essential. This needs to be done by your financial planner. If you are a do-it-yourself investor, or even if you are working with a financial planner, you need to ask this question to yourself or your financial planner. What can go wrong? What can go wrong? And what can go wrong? Because the future is never certain. Future is always uncertain. Future will not behave like the way we anticipated. Some people thought that the bank FD rates could be 8%, 9% permanently. Now you see unimaginable thing that is happening. The banking FD rates have fallen down to around 5% or lower than this. People think they will jump back to 9%. That cannot happen. But if you are counting that you have to get 9% from your bank interest, that may not happen. So if you keep asking this question, what can go wrong? You will possibly find an answer. If you expect interest rates to fall down, you can think about forward contracts. You can think about subscribing to some guaranteed return plans, or you can invest in something else, probably which will give you a higher rate of return in the beginning itself. Likewise, when you ask this question, what can go wrong, there can be several answers you may be getting. For example, I may move out of this particular place. I may move to some other country. In that case, do I have to own this property? And you move out of this place or to another country and you are left with this property here. And if there is nobody to take care of this property, and if property is a part of your financial plan, it can badly suffer. Likewise, you can ask, do I have a guaranteed job? How safe is my job? If my job is not there and if I don't have enough emergency funds, whatever the contracts that I have got into, be it the EMI, be it the payments towards the properties or payments towards some of the retirement plans where you have got the contract, how will you make the payment? So always keep asking what can go wrong. When your financial planner talks to you, or when you read through a newspaper report, or when you read through the performance of a mutual fund, you mentally make up a picture that you are going to get 10%, 12%, 16% return. People say you will be a crorepati, you will be a dollar billionaire. These are all fine. This will kick up your emotions. But stop for a moment and think what can go wrong. There is every possibility that everything can go wrong at some point of time. You need an example. We are passing through this pandemic. Nobody anticipated this. If you have drawn up a plan without taking all these things into consideration, your financial plans can badly fail. Point number 5. When you draw up your financial plan, you must know your cash flows. Knowing cash flow is one of the most important aspects of creating a successful financial plan. What are my cash flows? Where will my money come from? Is it my business income? Is it my dividend income? Is it my salary? Is it my interest? What are my sources of income? In a month's time or in a year's time, this is the cash flow that I am going to get. How safe is this cash flow? One of the customers who came to me in one of these days, he said that I'm going to join this contractual product. I asked him, where is the cash flow coming from? He said, I have a lot of dividend paying stocks and I get so much of a dividend. I use this dividend to pay for this contractual product. I stopped this gentleman and immediately told him, look, you may think so, but the dividends are not guaranteed from the company. If there is an economic downturn, the companies may stop paying the dividend or they may bring down the dividends. Anything could happen. So don't count on your dividend and join into some contractual product. If you want your dividends to be reinvested somewhere, the better place for you would be to invest in something where you do not have a contractual obligation. Likewise, people think they have guaranteed jobs. They buy big properties. They get into a fat EMIs. They buy bigger houses. They want to take a housing loan for a short period of time and they stretch their EMIs to a very high level. So, in your financial plan, make sure that the total contractual obligations you have towards your EMIs or to payment to different particular plan does not exceed, ideally, not more than 40% of your cash flow. Even in case of in an upper case, I will say don't go more than 50% of your cash flow. When you stick to this particular point, what could happen is that if there were to be a cash flow issues going forward, the remaining 50% of the money which you have not contractually got bound to pay for something will come to your risk. You could have kept it as an emergency fund. You could have kept it in an FD which you can liquidate. You could have held it in some mutual funds where you can liquidate that. That will come to your rescue. Know your cash flow very well. Find out how secure your cash flow and what can go wrong. And your contractual obligation should not be more than 30, 40, and at the most 50% of your regular cash flows. Last but not the least, when you drop a financial plan or get into a financial plan, don't miss the larger picture. When I say larger picture, it only means to say know the purpose for which you are doing it. If you are doing it for educating your children, remember your children go to college at 17, 18 years of your age. These children will need a large sum of money to educate them for higher studies over next 3, 5, 6, 7 years, depending on what course, which place, which universities they go for. If you're doing it for the sake of retirement, remember this retirement starts at 60 years of your age. If you're 30 years old now, you should know how much of money you can put in there. Now the purpose becomes very important. That's the larger picture. What tool you use to achieve this is a choice that you make. If your retirement is far away, you can take some of the high risk instruments like the large cap mutual funds or the index fund or a portfolio of mutual funds. If you're already very close to the retirement or already have retired, then your exposure to equity and other things should come down. Don't buy a mutual fund, don't buy a stock because it is doing very well. Buy any of these products because you want to achieve a particular financial goal. Have a word with your financial planner. Find out what instruments are suitable to you and only invest in those instruments. See, here these instruments are only the tools to achieve your life goals. Your life goals is a part of your larger plan. Do not remove life from your financial plan. At the end of the day, the purpose of writing a financial plan is to achieve your life goals. It is not to make a large amount of money. It is not to make you a millionaire. It is not to make you a crorepati. Money in itself, in isolation, has no value. Money finds its value only when you apply to your life and when it adds value for you to achieve something in your life. Dear viewers, hope I have given you enough points to ponder how to make your financial planning a successful one. If you are a person who is looking out for the services of a financial planner to draw plans for you, you can make best use of our services as well. I have shown my contact number here on the screen. From any part of the world, you can send us a WhatsApp message, and based on your inputs and what you want to do, either myself or one of our team members help you to write a good financial plans for you. Dear viewers, if you think the topic that I discussed today helped you understand the financial planning process and it was of use to you, please like this video. Don't forget to share this video with your near and dear ones. Thank you very much for watching this episode on NRI Money Clinic. I will be back with you with yet another topic in yet another video very, very soon.
Press the bell icon for more details and subscribe our channel.